Hello and welcome to the show. I'm Puneet Wadhwa, and we have with us Andrew Holland, CEO, Avendus Capital Public Markets Alternate Strategies. Hello, Andrew, and welcome to the show.
Good morning, and thank you for this opportunity, Puneet. Always a pleasure.
Diwali is all about happiness and the festive spark that brings cheer all around. Is the spark missing this time as far as the market action is concerned, Andrew?
Well, I mean, for our Indian markets, I think everyone's still more optimistic. We've decoupled ourselves, from global markets, but unfortunately, the backdrop globally is not supportive. So perhaps we have our own enjoyment this time around, but it's tough when each day there's something happening, which is probably more negative than positive globally. And that just affects the kind of overall overriding sentiment that India is doing well. It's the fastest growing economy in the world. Its currency, whilst depreciating against the dollar, hasn't done that badly. It's appreciated against other currencies. So that kind of falls by the wayside a little bit because of the global factors. But I think the heartening thing is that domestic investors continue to put money into the markets, and that bodes well for the future. Maybe not now in the short term as we head towards Diwali, but I think that sentiment won't go away unless there's something more global which happens between now and Diwali.
The market, in terms of the headline number from the front-end indices, hasn't done much this year. However, there have been stock-specific stories. So is that how the markets will be in the foreseeable future, according to you?
Possibly. I think this divergence in kind of sectors and companies is the usual divergence you get anyway when you're going through some headwinds. But I think going forward is what's the themes going to be in 2023. Now, obviously, one big theme will be, when does the central banks, particularly the Fed, put a hold on interest rates? Right, so that's going to be one theme, and that will play out. But the bigger theme in terms of where you're going to get, and that obviously you can look at that and say, okay, the banking sector would do well with interest rates on hold and so forth and so on. But what will be the other themes that play out? And we still think that 2023 will be start of a big corporate capex cycle and government capex cycle globally. And it's going to be in those areas which we probably know already, like defense, renewable energy. But I think the big factor that will play out will be capex by either governments or corporates, or a combination of industries where there's been a supply chain security problem, or you want to diversify away from China. So semiconductors would be one example for India. But that's going to be prevalent throughout the kind of capex cycle globally. So when you look at capex, you usually think in India it's the normal roads, bridges, and so forth. But I think this time it will be slightly different in terms of where you should be looking. So will it be the smart factories, the smart buildings, whatever it might be? Who's best prepared? Is it the kind of ABB, Siemens of this world who would capture that, rather than the kind of normal L&Ts and BHLs on the pure kind of roads and bridges and so forth. So I think that's going to be a new theme that plays out. And I think the other theme which will play out, Puneet, is that we all know that there's safeguards now surrounding China imports. I think the electronics industry in India is going to boom. Now there's a lot of companies, not so many large caps, but a lot of mid caps. And I think that's where to focus energy and attention in terms of finding some of those winners going forward.
Is there any silver lining in store for the market in the next Samvat? I mean, the Indian markets as well as the global market. And in the Indian context, what are the key themes or sectors you are working with where investors could park their money?
So I think if I was to make a kind of a prediction, which is always fraught with danger at the moment, Puneet, I would say this. I would say for sure that the Fed and other central banks will go on hold. I just don't know the exact timing of that. It could be after this November, it could be December, but I think going into 2023, they will go on hold. Okay. Now, the next question is, when will they pivot when will they start to say, okay, interest rates are too high, we need to bring them down? I think that will be on the onset of a recession. And I think that's what's going to happen. So that's the kind of good news, because once that happens, and things will be priced into markets, and when you're looking at the growth, then India will stand out, globally as it is today, and investors will come and put money towards emerging markets, and India will be obviously a big portion of that. Now, why am I saying emerging markets? Because I think also, if we're going to that pivot, okay, then the dollar will weaken at some point. And therefore, emerging markets, I think, would be the place which you're going to get growth and you're going to get performance. And that's what I think will happen. Now, timing of that is always difficult, but I think that's a 2023 story. And I think how I would play that would be banking and autos and auto parts, because they're a good play on deflation as such, because inflation will start falling as you go into recession. And then those other themes which I talked about, which is capex related, would be the kind of areas, and electronics, I think will be the themes that play out in 2023.
Rearrange these asset classes in order of your preference in terms of the likely return in the next 1 year. Starting with the largest first: gold, large cap stocks, mid and small caps, real estate, bonds, or fixed deposits? Or should one just stay in cash till the time uncertainty is over?
So you're talking here a little bit about asset allocation, and if I was to think about that today, I think it's a nice combination you can do, right? I mean, probably got one more rate hike from the RBI. I would then look to lock in some of these, high kind of fixed deposit rates at whatever they are, 7.5, whatever that they'll land at, for the next 1 to 3 years, because that's a good solid return, which I'm going to be getting from part of my income. I then supplement that with more and more money aimed towards equities, because I think emerging markets and India will perform well next year, and we'll be back to that kind of a kind of normal kind of maybe 12% returns, which we've seen over the last 10, 12 years or so. So I think that, but of course, what we talked about is some of those themes will play out. So being in the right sectors will obviously be something to play on. So I think I'd probably, in the very short term, be more geared towards locking in some of the yields, and then with the excess, whatever excess money I have, then start pushing that into equities going into 2023. Gold really hasn't proved to be a safe haven in terms of inflation, so I'm not sure why that is at the moment. So that's what I'd be looking at. I'd certainly be looking at alternative, asset classes to try and kind of help me in that yield curve in terms of between debt and equity, and the risk that you would have in those asset classes as well. So a combination of debt, equity, and using alternates as a way to play into the markets.
So what's your advice to the retail investors as we head into the new Samvat?
I think, listen, they've been doing well, right? I mean, they've continued with their SIPs. Yes, okay, they haven't made the returns maybe over the past year, but the markets haven't suffered as badly as other markets. So, I think that kind of consolidation, whether it's a little lower or a little higher, I think is a good base for when the Fed stops raising rates or pivots going forward, for our markets to make that move forward. So I would say continue doing the same. The only thing I would say is, obviously, whenever you're looking at your pool of money, is it's the opportunity cost of being somewhere. So try and look at different asset classes, which will help bring gains over periods of time, maybe not all together. So, for example, you probably would have not made so much money in fixed income in the recent past because of interest rates rising. But if you expect interest rates to fall next year, then obviously that will play out for you going forward.
Thank you, Andrew, so much for your time. We hope to see you again.
Always my pleasure.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.